we often study the largest stocks in the markets, and we focus a lot of the attention on market quality and market structure, on how it is working for those largest stocks. But and we can see that market quality has improved over the, say, last 20 years. It has improved a lot for the large caps. But for mid caps and small caps, there's a completely different picture, and it's not that obvious that continuous trading is the way to go. So we will have one presentation about continuous trading, and here we will have, we start with Benjamin Clapham from Goethe University, and Benjamin will talk about the market fragmentation drivers and effects, with particular focus on the SMEs. So I think that will be really interesting. The floor is yours.
Thank you very much, Björn. So welcome back, everybody, after the coffee break, and thanks so much for having us on the program and for the nice introduction. Basically, Björn just summarized the whole paper, but I know I want to give a bit more detail into this. Nevertheless, I want to skip some of the more technical parts and therefore talk a bit about some policy implications thereafter. So this work now is about drivers and effects of stock market fragmentation, insights on SME stocks. This is joint work with Jens Lausen, Peter Gomber, and Micha Bender, also from Goethe University. And what is important for this presentation, now that we now have learned a lot about dark pools and SI in the previous two talks, this talk again now focuses completely on lit trading. So we only study fragmentation, and this is kind of a caveat that I have to say here, lit fragmentation. So fragmentation, open limit order books, and what does this level of fragmentation do with market quality of large stocks, mid stocks, and smaller stocks. Just a quick motivation. So Björn already told us that there's a lot of empirical and also theoretical research on market fragmentation. And we actually have learned that in theory, it would be good to consolidate every single order in one pool to have the largest liquidity possible. However, then we have monopolies. And we also have learned in Economics 101 that monopolies are never good, because then we have huge transaction fees at the exchange level, and we also have very little innovation at the exchange level. So from this point of view, fragmentation is necessary and beneficial. However, there are also some theory work of older literature that says, well, if we split up liquidity across different pools, then we will might get some problems because we will have higher implicit transaction fees. However, this is not what we saw in the empirical literature. So there's a lot of literature which studies the impact of increasing lit market fragmentation on market quality, and basically what they find for large stocks is that actually we find that market fragmentation improves liquidity. So why is that? Possibly this is due to HFT and smart order routing technology, because then we can kind of create a virtually integrated marketplace out of these different liquidity pools to then get the benefits of fragmenting and breaking monopolies, but at the same time having deep liquidity by virtually integrating these different liquidity pools. So this is what literature found. However, we also have a lot of other stocks that are not in the media every day, or which are not traded very, very frequently. And for these stocks, we have on the one hand a very lower activity of HFT traders. So basically maybe the connectivity of these different markets is lower than for large stocks. And we also do not have very much research on SMEs. So this paper tries to close this research gap by looking at the impact of market fragmentation also on these SME and other less frequently traded stocks. This is even more important in light of the statement from the Federation of European Securities Exchanges in 2019, who said or who claimed that actually they feel that they see negative consequences of market fragmentation for SMEs and other small issuers, and they proposed that wouldn't it be a good idea to allow SMEs and other small issuers to prevent their stock from being fragmented, so that they can say, I only want to be traded on the primary venue, and that's it. So this is the statement, which I would like to revisit later on after I have presented my results. So basically, this paper is about what is the impact of market fragmentation, lit market fragmentation, on smaller and less actively traded stocks. To do so, we have two different analysis steps. The first one is we want to understand when and why stocks actually fragment. So we do an event study approach and discover what are actually the drivers of a stock to fragment. And then we also look how these fragmentation events actually affect the quality of these stocks. I will skip this one for this presentation because we also have the second analysis where we use a wide range of different stocks covering small and less actively traded stocks, also as large and liquid stocks. And then we regress what is the impact of market fragmentation on the wide range of market quality parameters. Let's look first at the drivers of market fragmentation. So in this data set, it's going back until 2009. So we take the entire period from MiFID II onwards, MiFID I onwards, and we take the data on a quarterly basis from Fidessa. And here we include all relevant main markets on which a stock is traded. So we take for every market the incumbent exchange, so be it Nasdaq Nordic for the Nordics, or LSE for UK stocks, or Xetra for German stocks, and add them these data with the main alternative venues being Equus, the CBOE CX book, so the previous Chi-X book, the CBOE BX book, so the previous BATS book, and Turquoise. And then we measure fragmentation in the following way. We use the inverse of the Herfindahl-Hirschman index, which is a common concentration matrix in economics. So basically, it squares the market shares of every player, in our case, of every market center, and we take the inverse of it, which says basically that if the inverse Herfindahl index is at 1, we just have one exchange, and if it gets larger, we have more markets over which the trading volume is dispersed. And we also look at SME and non-SME stocks, by which we define a threshold of 1 billion euro, which is also in line with recent European regulatory actions, and differentiate stocks between this market cap categorization. And we also take the liquidity classes that are also used for tick size regime and split the stocks in the 6 classes that are used in the tick size regime. Basically, we have very infrequent traded stocks which have just 0 or 10 trades a day, or the next liquidity class is then from 10 trades to 80 trades a day, and so on and so forth. So we have 6 different classes of differently active stocks. And now the question is, do we see a difference in these stocks? And this is the first descriptive result. Actually, yes, we do. Please note the 2 graphs have different scales, so the difference is even larger than shown in this image here suggests. So for SME stocks, we actually have very low levels of market fragmentation. So in the early days after 2009, after MiFID I, we almost have no fragmentation at all in SME stocks. And this only increased gradually a bit over the time until the Herfindahl-Hirschman index for the 75th percentile of 1.4, but which is still very, very low. So these box plots here, the green bars, they represent the mass in the 25 to 75th percentile, while the whiskers represent kind of the maximum that we observe in the data. So the key takeaway is we see a lot of fragmentation in non-SME stocks, which also increased over time, recently decreased a bit also with increasing closing auction volumes on the main exchanges. But for SME stocks, we see much lower levels of market fragmentation. This is also confirmed when looking at these descriptive statistics here, which are, on the one hand, again, differentiate between SME and non-SME stocks, but also according to 2 different characteristics, being the market cap of a stock and the trading activity of a stock benchmarked by the different liquidity classes. And what we see is that both for SME and non-SME stocks, we see that the fragmentation level increases the larger the stock is, and we also see that trading activity increases the higher the trading activity is within a stock. While for those stocks that trade very infrequently and those stocks which are very small, we see almost no fragmentation at all. So takeaway is, descriptively, we see strong differences in the level of fragmentation for SME and non-SME stocks, and we also see that fragmentation varies for different levels of market cap and trading activity. So the question is there kind of a selection of market fragmentation? So do trading venues, alternative venues, for example, selectively choose which stock to list on their venue, dependent on certain characteristics, and do traders specifically choose where to trade a stock dependent on its characteristics? I don't want to get into details here, but the first model here now just looks whether the likelihood of being traded on multiple venues is dependent on stock-specific characteristics such as market capitalization and trading activity. And the second regression, which I want to show you, now accounts for the levels. It asks, are the levels of market fragmentation dependent on market activity and trading activity? And the answer is, for both models, yes. We see actually that these stock market characteristics drive market fragmentation. So we see that larger and more active stocks are more likely to be fragmented, and we also see that this selection, that there's actually a selection which is incorporated here in this inverse Mills ratio, which is significant, which says, yes, there is a selection of stocks concerning market fragmentation. And we also see that these two characteristics, being size, market cap, and trading activity, trading volume here in this case, drive the level, so the magnitude of market fragmentation. So we have identified two major characteristics that drive fragmentation. So the question now is, what are the effects of market fragmentation? And specifically for stocks that are smaller and traded less frequently. To analyze this question, we draw a subset of the stocks that we studied in the previous analysis, and now obtain intraday data for all these venues that I already covered from BMLL, which is the data provider that we used. And for these three markets that we analyzed, which is stocks traded at Euronext Paris, LSE, and Xetra, and the corresponding alternative trading venues, we consolidate all order information into one single consolidated book. So we take the information which is available in every single order book, we consolidate it, and we measure all our metrics against this consolidated book, because the intuition is that investors have the possibility to kind of route their orders to different venues, so they have the access to the entire book. So that is why we measure all our market quality measures based on the consolidated order book. And again, we pay particular attention to these liquidity classes, so we differentiate, or we run our analysis separately for each of these individual liquidity classes, being from 1 to 10 trades a day with the smallest, or larger than 9,000 trades a day for the most active stocks. Let's look at some descriptive statistics. What I want to show you here is that on the one hand, our stocks are kind of distributed over all liquidity classes, so we have a lot of stocks in each of these classes. And what we also see is that the smallest stocks are obviously in the less liquid classes, so SMEs make a huge proportion in these three lowest liquidity classes, but we also see some SMEs in the more active classes. And what we also see is that fragmentation rises, there's a monotonicity concerning the level of fragmentation from the less actively traded stocks to the most actively traded stocks. And we see, for example, for the lowest liquidity class, that we actually observe more or less no fragmentation at all, with a median fragmentation of 0, so being 1 in the Hirschman index, and a mean fragmentation of 1.02, which is still very, very low. I will skip the rest of the descriptive statistics in the interest of time. So what we do now is the following. So to rule out that we have other effects that might bias our results, and to control for different things that are going on into the markets, we, for each stock, we use a match, a perfect match, so to say, concerning its characteristics in terms of size, liquidity, and trading activity. So we use a methodology proposed by Davies and Kim, and search for every stock, kind of a match, which is very similar in all these characteristics, except for the level of fragmentation. And then we take the difference in the stock's market quality parameters, for example, the difference in spread or the difference in market depth, and regress this on the difference in market fragmentation, on the level of market fragmentation, and some other control variables. And thereby we want to explain the difference in liquidity by the difference in the level of market fragmentation. This is basically the idea of this setup. And I want to directly jump into the results, and what we find is, concerning the relative spread, that we can confirm findings of previous studies that indeed higher levels of market fragmentation lead to decreased spreads. So we have more liquidity in the market for those stocks. However, our results also show that we do not observe any effect in the smallest liquidity class concerning fragmentation. So basically we can say fragmentation here plays no role / has no effect on the level of liquidity. And in this second to last category here, we actually see that liquidity decreases due to higher levels of market fragmentation, which is something which was not revealed in previous literature. So basically we can see that spreads rise with high levels of market fragmentations for the large and actively traded stocks. However, for small stocks, it depends on the level of activity, right? So for those with the lowest liquidity, we don't have any effect. For those which have a little more trading activity and also more level of fragmentation, there we see actually detrimental effects. And once they kind of make it over this threshold, then we have positive effects of market fragmentation. And this exactly the same saying also holds when we look at the depth that is available at the first level of the order book. Here we also see negative effects for the level liquidity class 80, and then increasing depth with the higher liquidity classes, while the smallest liquidity class has a non-significant effect. So basically what we observe is kind of a hockey stick curve of the level of market fragmentation, or the impact of market fragmentation on market quality, being that we have a no effect for the smallest and least liquid stocks, then have a negative effect on the kind of stocks that do observe some levels of market fragmentation but have still little trading activity. And once the stock comes across this threshold, then we see positive effects of market fragmentation on market quality. And basically, our results show that this is the second to last liquidity class which shows these effects. So basically, I just want to skip to jump to the conclusion and to the policy implications. This study provides two major results. The first one is market fragmentation is not exogenous, but it depends on stock-specific characteristics, which are stock size, measured by market cap, and trading activity. And also, we find that the impact of fragmentation also depends on these two characteristics, and that we actually observe kind of a hockey stick effect on the impact of trading activity. On the impact of market fragmentation, which is triggered by trading activity. So what are the implications of this? In general, we confirm that lit market fragmentation is beneficial for stock markets, which is also confirmed in other studies. So fragmentation leads to increased liquidity, and we can get both of the fragmentation story, competition between venues, lower transaction fees, but also lower implicit transaction costs. However, I started with this quote in the beginning: industry participants are worried about negative consequences of fragmentation for SMEs and other less actively traded stocks. And I posted the quote again from Fese, and they suggested, as I've shown in the beginning, that SME issuers should be able to limit trading activity of their stock to one single primary venue to get better conditions for going and being public, for pooling liquidity in one place. And the question is, based on our results, is such a regulation necessary or meaningful? And I would say our results show that there's no one-size-fits-all solution for SMEs, because there are SMEs which are very, very infrequently traded, but there are also SMEs which are more frequently traded, which have the possibility to reap the benefits of market fragmentation. Because we have shown that if SMEs fragment, the effect is initially negative, but then becomes positive with increasing levels of trading activity. So the effect of fragmentation on SMEs is very case-specific and dependent on the activity level of the respective stocks. So from our point of view, a regulation allowing SME issuers to prevent their stock from trading alternative venues is not necessarily linked to better or more efficient markets, because probably those issuers who would actually benefit from market fragmentation would say, no, stop trading my stock on other venues. But those potentially that would suffer from trading on other venues would say, yes, you go for it, trade me on other venues as well. So the better way to do would be to create kind of an ecosystem in cooperation with market regulators and market operators to get more liquidity to such stocks so that they more quickly reach this tipping point from which on market fragmentation becomes beneficial. So for example, be it by liquidity provider programs which are designed to specifically cater the needs of these very infrequently traded and small stocks so that they attract enough trading interest to reap the benefits from market fragmentation. So with that being said, I'm at the end of my talk. Thank you very much and looking forward to questions.
Thank you very much, Benjamin. The discussant is Sean Foley from Macquarie University in Sydney.
Yeah, I can.
Okay.
Can do it, I think. Yeah.
Oh, okay.
Yeah, sure. Great. Thanks so much for having me. It's really great to be back in Stockholm. It's been some years from the pandemic since I've been able to travel outside of my own country, and so it's great to be here and discuss this paper. So I think it would be useful to have a bit of an understanding of how fragmentation has occurred within the global context. If we think about Europe, obviously we have the MiFID passporting, which really facilitated this idea of fragmentation within the European context. In the US, we had the Reg NMS, right, which sort of built this consolidated tape and encouraged fragmentation there. In other global contexts, obviously I come from Australia, and this was really endogenous, actually. You know, the Chi-X came in and said, oh, look, we'd like to do this. And we see other similar examples in Japan and alternate jurisdictions. And one of the, I guess, impetus for this change or this fragmentation, particularly endogenously, was this historic monopoly of the primary exchanges, right? The Australian stock exchanges of the world did not have a strong impetus to innovate or to price competitively their execution services. And I think that this really drove the introduction of competition globally. What we've seen from the academic literature is that there has been a significant impact of this competition has reduced spreads and reduced these explicit costs, right? Exchanges who now face competition from the Chi-X, CBOEs of the world, they have to start kind of pricing their services more competitively, becoming more innovative, and we start to see market makers, you know, electronic market makers, Citadel, Vertu come in and start competing with each other more competitively. So we see increased depth, we see reduced spreads. This is a relatively, at least amongst the more liquid securities, this is a reasonably uncontentious empirical finding across many different jurisdictions. I've looked at it in Australia, for example. But this does come with costs, right? The fragmentation is not free. The brokers need to make these fixed connections to the alternate venues. They need to invest in the technology, the infrastructure, smart order routing. And most contentiously, they also have to pay these ever-escalating data fees, right? So there are these sort of costs and benefits, I guess, of fragmentation that really need to be kind of balanced. If we think about the paper that has been undertaken by Ben, it's really interesting because we typically look at the most liquid securities and think, okay, well, what happens in the top 50, the top 100, the index securities that's most actively traded? And yet, you know, you think about a country like Australia, we have, you know, 2,200 listed securities, and we may typically analyze 200 of them, and we just ignore the 2,000. And obviously, Europe is the same, right? Ben is looking at 10,000 securities. I'm sure this is not the investable universe for the majority of index funds. And so, you know, he sort of looks at these two components. Well, what drives fragmentation, and is it sort of beneficial or not, at least amongst these SMEs? And he finds that, look, fragmentation is not exogenous. Larger, more liquid stocks tend to be chosen to be the ones that fragment. And this fragmentation is, you know, maybe a little bit negative or more or less indifferent for these smaller stocks and positive for the larger stocks. So this is the kind of main takeaway that I received from this paper. I wanted to give you, you know, I think one of the other really interesting components of Ben's work is that you look at fragmentation not just from a monopoly context to a two-venue context, right? This is where a lot of the empirical work in academia started, right? We went from, for example, my paper, I look at the introduction of Chi-X. You go from a monopoly to a duopoly, or, Foucault and Megveld look at the introduction in Holland of a single alternate venue. And what Ben's looking at here is like a number of venues. So I wanted to just put this is a graph from one of my own papers, I'm sorry, where we looked at the introduction of subsequent venues into Canada. Okay, so I've done a lot of work in the Canadian context, and looking at, okay, well, on the left we see the first introduction of Pure in 2007, and we see on the orange lines is the difference in basis points. So we see a reduction of maybe 1.5, 2 basis points, and the blue line gives us the T statistic. So above 2, this tells us like it's pretty significant. Like really, there's a strong effect here. It's quite significant. So you see that, yeah, okay, we maybe the first introduction or the first venue, it was really good. This is consistent with our sort of existing findings, right? The second venue, it's still reduced, maybe 1 basis point, still quite significant. The third venue, Chi-X, okay, still reduced, quite significant. The fourth venue, the blue bar is not there, right? So it's like, well, yeah, it might be lower, but we're not really sure. And the fifth venue, and the sixth venue, the seventh venue, it starts to become really unclear that there is an additional benefit of the fifth venue, the sixth venue, the seventh venue. And I think the thing that's really nice about Ben's paper is he doesn't just look at what percentage is in the, the home market or what percentage is away from the home market, but rather he looks at, well, what's the distribution across these venues and how does it matter, or does it matter, when we have this, this sort of competitive nature amongst the fragmented venues. I guess this kind of drives me to, well, how should we measure fragmentation, and how does it, does the way we measure it really matter, right? So this is a picture I've borrowed from Ben's paper, and the way that the inverse Hirschman, sorry, my German is not great, the inverse of HHI, the way it works, like if you have 5 markets and each of them are equally distributing the volume, right? There's 20% at each of them, you'll actually get a value of 5. Right? If you have 4 venues and it's equal, you get 4. That's a really nice thing about the inverse HHI. It's very easy to interpret. What we see, though, if we look at the SME stocks, is the average level, it kind of gets to like 1.05. Right? So if we look at the primary venue or the larger stocks, you're getting like an average of maybe 2 venues, maybe 2, 2.5, maybe, right? So you're looking already at a point of fragmentation that is super low, right? This is equivalent, like a 1.05 is equivalent to like 96% of the trading being undertaken on the primary venue and maybe 4% existing across the other remaining 5 venues. So we're talking already about a very low level of fragmentation. And so I'm not necessarily, he can't change that, right? It's not his fault. But I think it really makes it important to think about in the context of how we generalize these results, right? Do we find no result for the very small SMEs that trade infrequently because fragmentation is not harmful, or because we don't know, because what we see is 1% alternative venue market share, right? So I think this becomes really important. And kind of leads me to some of the ways I tried to overcome this problem in my own research. Because obviously when you introduce a new venue, the new venue starts at 0% by default, right? And so this is always the problem with these kind of studies, like, here's my event, Chi-X launched. You go, great, what happened on day 1 of Chi-X? Well, there were 5 trades. So what does that let me, when is my event truly then, I think becomes the kind of question, right? And so there are different ways that you can try to approach this, right? You could say, well, let me just take a dummy for when the fragmentation exceeds a threshold, right? So if fragmentation is greater than 5% away from the home venue, then maybe I say, okay, well then that's really when the stock fragmented, not the first day there was a trade in an alternate venue. Maybe I can look at the date of introduction, I can use some kind of rolling window, right? I could take, well, what was the average level of fragmentation in the last 30 days or something like this. So I think using some of these alternate measures, not just looking at the HHI, but sort of trying to get at, well, when was there true competition here, I think can try to tell us a bit more, right? So get away from the fact that, okay, does 1% fragmentation really matter? Maybe that's not the question, right? Still look at the SMEs, but look at, well, when it's 2% or when it's 5% or something like this. If we think about what causes fragmentation, I've found, I don't know if you go to the supermarket, I have to go to the supermarket, and, if there is a line, and there's long lines, right? Maybe me and my wife are going to join 2 different lines, right? And then whichever one gets to the front first, we do that. Sometimes, I don't know if you've experienced this, but you're in a really long line, and then they open a new checkout, right? And everybody runs to the new checkout, right? Because they think, oh, I'm going to get served very quickly here because I'll be the front of the line. So I think this is something that is really driving fragmentation, at least endogenously from my observations in the Canadian market. When they introduced new venues, the stocks that chose to trade on those alternate venues were the stocks that had the longest queues, right? Because if I can jump the queue, I can reduce my adverse selection. I prefer to be at the front of a short queue than at the back of a really long queue. And so I think this is one of the results that we're kind of seeing come through indirectly from Ben's research, right? If we look at, the queues that we see, well, more larger stocks or more actively traded stocks are the ones where you're going to get more endogenous fragmentation. So I think if you can look at depth, if you can look at the level of constraint that those securities have, you're going to find that those may be some drivers. I did some stuff about trade through best X. Yeah, so policy implications. Look, I think there are benefits for large stocks, is what he finds, no disadvantages for the SMEs. But I think it's really dependent how you measure it, right? Obviously, if you measure the primary market and you see fragmentation, you'll say, well, it was bad for the primary market, right? So I think it's important to think, do we measure the primary market, the MBBO altogether, and think about, well, who are we trying to determine if this is better for or worse? So thanks, really interesting paper. All the best with it.
Thanks a lot for discussion. I generally particularly liked your comment regarding how we should approach those stocks which show hardly any level of fragmentation, right? So I think that's a really good comments concerning how we measure fragmentation, in particular for those stocks where we can discuss whether they are actually fragmented or not when we see an HHI from 1.05, for example. Yeah. So thanks a lot.
So do we have any questions from the audience?
Yes, very interesting, especially as you had that small bucket where you actually said that fragmentation could hurt the liquidity, because we will have an event coming up here in Sweden where we have our Nordic growth market, which is more or less only small companies listed that will get a dual listing on the big Nasdaq market. So would you argue that, could you measure, do we have any metrics where you could measure where it starts at how low the liquidity needs to be when it becomes harmful? That bucket will probably be interesting in that debate, because that's obviously the main argument from the small exchange, that it will hurt liquidity with a dual listing on those shares.
Yeah, thanks a lot for this question. This is actually a cool event which we could use also for our study to analyze how this actually evolves. Well, if I go back to the paper, it's basically, so what our results show based on the liquidity thresholds that are provided also in the European tick size regime. That's what we use for the liquidity classification, and there we see that it's the second to last bucket, which is the bucket between 10 to 600 trades a day, where we see problematic effects of market fragmentation. So basically, if one takes these results, one should pay particular attention to those stocks which are in this area concerning the trading activity.
Yes, thank you. Really, really interesting. And I think the one question, could you, as we do in Europe, we need more SMEs, we need more listings, we need more investments, not least by retail investors. And of course, fragmentation, for better or worse, may actually lead to SMEs being exposed to more market participants, etc. So and could you elaborate a bit about your findings on the cases where you do have SMEs where fragmentation has actually, over time, kind of possibly led to more liquidity, which is then likely also the same as more increased interest from investors, because there seems to be kind of a positive circle or a way there. In your findings, did you look at what kind of SMEs, etc., we're talking about, or are there any particular characteristics that stand out in that segment?
Also a very, very good question. So we didn't look into the, for example, the industry or other kind of these characteristics, business models of SMEs. We didn't check that. But what we observed is that we kind of see a growing up of firms of SMEs once they are being public and once they are traded more and more and more and more. Then we see level fragmentation comes in, then we see spreads and so on decrease, depth increases. So we see kind of a growing up story of stocks. So you have kind of to reach that tipping point from where on both fragmentation increases as well as liquidity increases, and these two kind of support each other in being or providing better market quality for SME stocks. Yeah.
A related question regarding your classification of SMEs. Does an SME stay as an SME during the entire sample, or is it a dynamic process where a firm can be a stock can be an SME in the beginning and then something else towards the end?
Yeah, it's a dynamic process. So once this once the company crosses the threshold of 1 billion euro, it is not considered an SME anymore for our analysis. Yeah.
Because it didn't come through the presentation because you used the tick size table, which is towards the end of the sample. That's from the MiFID II, right?
Yeah, correct.
Table. So maybe you should use something else to indicate that you are actually having a dynamic process, not something that you observe towards the end.
Yeah, sure. Thanks.
I have a related question, I guess. I know it's hard to get hold of the data to see which of these small companies that have paid the liquidity providers, but that could be a possible explanation for your empirical finding with the hockey stick, that it's an endogenous choice for listed companies to pay someone to provide liquidity in their stock, so to speak. Maybe it can be done for a small subset or something. That would be interesting to see.
Very, very good question. So you're right in that we have to control kind of for designated sponsors which act on behalf of the issuer and create liquidity on behalf of the issuer. And for example, in the German, so the good thing is we have different markets in our sample. And in Germany, for example, as a small company, you have to have such designated sponsors in place, which is a little bit different in France, for example. But we see these results for both markets if we kind of reduce the sample and look at each market separately. But still, I think we have to go deeper in this and maybe manually check for a subsample directly how many designated sponsors are active, and maybe check also their characteristics and so on and so forth. So because they definitely play a role, right? That's also what I suggested as kind of policy implication. That's the thing that you need to get trades and trading activity to your stock.
Yes, thank you. So an institutional question, which may sound naive to non-academics, but I'm an academic, so I don't get to experience these institutional details firsthand. So namely, when you talked about the stocks selecting to fragment, I was just wondering, how does this selection process actually happen? Like, is it everything in the hands of the company management itself, or are like brokers involved? Because these different actors could have different incentives, whether to fragment or not. Yeah,
no, it's completely different. So the first choice is the alternative trading venue, which says I make this stock tradable on my venue. Then it's like Sean said in its discussion, then you in theory could trade the stock on this venue. So this is the first selection that has to be taken. But then also traders need to come and actually trade on this venue, and this is the first time when we see fragmentation. So first, an alternative venue must select the stock and make it tradable on its systems, and then second, traders need to actually trade on this venue. Then we have fragmentation. But the management is not in charge at all. So this is completely off their hands, which is kind of this FESE statement who claim this could be an ideal regulation for pooling liquidity again to one market if I allow the management to say, don't trade my stock at other venues.
So, Benjamin, I have a question that I know is outside the scope of your paper, but I'm asking anyway to see if we can get a more complete picture. So, do you know anything about fragmentation into dark pools and SIs for the SMEs? Has there been any work on that, or have you come across anything in the data? Is it a similar picture that they are very little fragmented, or?
Yeah, so we started looking in this, but actually there we have some activity also in dark pools for SME, obviously, and also SIs. But for the vast majority, we don't see anything. So we refrain from this analysis at this point of time. So it's kind of similar, but we have large trades from time to time in specific instruments in these venues. Yeah, so very infrequently, but then kind of larger volumes.
So just going back to the question before, you mentioned that the first step is that the alternative trading venue must make it available for trading. So BATS, Chi-X, Turquoise. Why wouldn't they always make it available for trading? You know, they want more fees, presumably. You know, why is it the answer always yes for these small stocks?
Well, in the past, they kind of had to build up their system, so they started with the most liquid stocks and then additionally put on the other stocks. But actually, I can't tell you why they don't list exactly in the time of listing every stock on their venue. Actually, I'm not quite sure. Yeah.
It's mainly because HFT's algos doesn't work with very, very low liquidity. So they kind of have a liquidity matrix where they enter. So that kind of is linked to this paper that you need to have some sort of market maker that's fixed that it's the same price in the fragmented market. So I think that's one explanation, that they don't see a benefit, and that their models doesn't work really well in very low liquid shares.
So the first choice is preempting the second choice because they don't want to have something trading zero when they open.
They need to have algos there and just taking risk with no volume.
Yeah. Okay. So the real dynamic is the second choice.
Yeah.
Great. I think we should move on to the next paper. Thanks a lot, Ben and Sean. And I'll welcome Roberto Pascual to the floor. So Roberto will talk about the effects of having continuous trading at all, and the alternative being to have frequent batch auctions.
That's right. So good morning, everyone. Let me first of all publicly thank the organizers of the event, Bjorn and Eric, for inviting us to participate. So this is a joint work with Ivan Intrigawan, who is at the Auckland University of Technology in New Zealand, and Andrew Skilko from Wilfrid Laurier University in Canada. So the 21st century has witnessed remarkable changes in the structure of financial markets, but there is a prominent design feature of the markets that remains unchanged, and that is the electronic continuous limit order book. As you know, under this market design, the participants place send messages, the orders continuously, and the matching engine processes the messages one by one in order of arrival. And in the event that two messages happen to arrive simultaneously, then the market host randomly picks which one has to be processed first. Is this continuous trading an optimal market design? So there is a study by Badish, Scranton, and Shim that develops a theory that in the context of modern high-frequency markets, continuous trading intensifies the adverse selection cost of the liquidity providers, of the market makers, increasing transaction costs as a result. And they suggest that the possible solution or a remedy is to substitute continuous trading by frequent batch auctions. Now, to give you an illustration of this theory, let me give you an example of latency arbitrage. Suppose that we have n participants in a market, and all of them have identical speeds, and they react to the same type of informative events. Now, they could be market makers providing liquidity, or they could be liquidity takers, let's call them snipers. After each informative event, a speed race is triggered. So the market makers will rush to reprice their stale quotes before being picked up, before being adversely selected, while the snipers will try to pick off those stale quotes before being repriced. So suppose that there is one of these informative events and all the participants send the orders simultaneously, and the orders arrive to the same time to the machine of the market, right? So this machine will just randomly pick one of them to be executed first. But remember that for each stale quote, there is only one market maker, and we have n-1 snipers, so the odds of being adversely selected are n-1 divided by n. So these odds are very high. So market makers will try to compensate this high adverse selection cost by keeping the spreads wide. Instead, in a frequent batch auction regime, where the messages are accumulated over relatively short periods of time before being matched, the market makers may be given enough time to reprice their stale quotes after each informative event before being picked off, effectively reducing their adverse selection costs. In fact, as long as the frequency of the auctions is not ultra high, the market maker should be able to reduce their adverse selection costs even when the other market participants are slightly faster. So what we do in our study is to use a recent opposite move from discrete trading to continuous trading in a relatively large and technologically advanced market, the Taiwan Stock Exchange, to empirically test Badish et al.'s main predictions. So what we're going to show you is that after the switch to continuous trading in Taiwan, adverse selection costs are going to substantially increase. But this is not the only market-making cost that it's affected. After the switch, other market-making costs that we summarize or aggregate in a composite metric that we call the realized spread, that captures things like inventory holding costs, order processing costs, decline. The first effect dominates over the second one, so in net terms, transaction costs increase after the switch to continuous trading. When we examine our results in the cross-section, we find that the stocks that were more affected by these changes were the higher volume stocks. And this is expected because this is where latency arbitrage is expected to be more pronounced, right? We also find that after the switch to continuous trading, the overall volume increases, and a further test that we run suggests that this volume is mostly toxic, driven by latency arbitrage. Indeed, we find that the traditional end users of liquidity reduce their participation after the switch, suggesting that there are lower gains from trade for these particular participants. And finally, we find no significant effect on price efficiency. We cannot conclude that the continuous regime is superior to the frequent batch auction regime in terms of price formation. Now, the Taiwanese Stock Exchange is one of the 20 largest equity markets in the world. It's comparable to markets like Toronto Stock Exchange or Australian Securities Exchange. But until recently, it was the only large equity market that was using batch auctions as a primary method to match buyers and sellers. And the auctions were run every 5 seconds. On March 2020, they launched the continuous trading platform, and immediately and simultaneously, all the stocks were transferred to the continuous platform. And to perform our tests, we use data on the 100 largest stocks listed in the market, and we take 1 year of data. And we collect trade and quote data for obviously the two regimes, the frequent batch auction regime and the continuous regime. As you have probably noticed, the market switched to continuous trading on the onset of the COVID-19 pandemic. So we must be very cautious in interpreting our results because there could be obviously possible confounding effects. So we try to mitigate this by using a differences approach. We're using a control sample of matched stocks from the Korean Stock Exchange. Why the Korean Stock Exchange? Geographical proximity, similar size, and similar measures taken by the authorities to deal with the pandemic. But we have also replicated analysis using an alternative control sample from the Hong Kong Stock Exchange, and our results are exactly the same. This is for the academics in the audience. What we do is pretty simple. Deep pool regressions, data aggregated at the daily level. We control for volume, volatility, trade size, and standard approaches, okay? So let me show you the results. First, we look at the main prediction of Buddy's et al. Theory. So we expect that after we move to continuous trading, adverse selection cost should increase. So we use the daily average price impact of trades as our measure of adverse selection costs. In the table, you have our univariate and regression results, and both of them show that after the switch, adverse selection cost goes up, so consistent with the theory. The numbers in the table translate into a 36% increase in adverse selection costs with respect to the levels observed during the frequent batch auction regime. So adverse selection costs are important for market makers, but as I said before, it's not the only relevant concern. What happens with inventory holding costs? What happens with order processing costs? What happens with the market making profits, with competition in market making, in liquidity supply? So first, there is no theory making predictions about that. There is no theory that compares, for example, inventory management in discrete trading versus continuous trading, right? So in the paper, we make some, we try to predict what could happen, but we find arguments to go in any possible direction. So at the end, what we expect to find is just, has to be given by the data, just something that has to be empirically tested. So we go to the data, and what we find is that our composite metric, the realized spreads decline. We find a 10% decline in realized spreads with respect to the levels observed before the switch to continuous trading. So if the Taiwanese market is competitive in terms of liquidity supply, we should expect that the market makers will transfer this change in market making costs to the liquidity consumers in the form of variations in spreads and quoted depth and so on and so forth. So we look at the effect on liquidity. And what we obtain is that liquidity deteriorates. So quoted spreads increase 30%, effective spreads increase 5%, quoted depth decreases minus 3.4%, suggesting that the increase in adverse selection costs outweighs the decrease in other market making costs. So the net effect on liquidity is negative. Latency arbitrage, which we expect is the main driver of all these results, has been found to contribute to make the prices more efficient, at least at high frequencies, right? So it could be that the increase in transaction costs that we have seen before is somehow compensated by a significant improvement in terms of efficiency of prices. So we test that next. And using different metrics for price efficiency, what we find is mixed results. I mean, the results depend on the proxy we use, or depends on the estimation horizon that we consider. In some cases, we find no effect. In some others, we find some weak improvement. So our conclusion is that if there is a price efficiency improvement here, it's not significant enough to compensate the increase in transaction costs that we had seen before. So in terms of market quality, the Taiwanese move has had a negative effect. Latency arbitrage, in addition to increased adverse selection costs, has been associated with changes in volatility and volume. So we take this possibility to the data next, and what we find is that after the switch to continuous trading, overall volume and volatility increase more than 5% with respect to the levels before the switch to continuous trading. Now that the volume increases in overall terms suggests that the potential increase in latency arbitrage volume is awaiting any possible decrease in volume by other market participants associated with increase in transaction costs, right? Now, to examine this further, we split the trading volume into what we call arbitrage or toxic volume and non-arbitrage volume. This is where I expect the academics in the audience to jump to my neck, but wait a little bit. So this is what we do. Our expectation is the following, okay? If latency arbitrageurs should respond to any informative event quickly by taking liquidity, and we expect the activity to quickly move the prices. So we expect latency arbitrage to be followed by quick changes in the quad midpoint in the direction of the trade. So all the volume that has this feature is classified as arbitrage volume, and otherwise is classified as non-arbitrage volume, right? So obviously our partition may not be pure, and we recognize that, okay? We can have, for example, in the arbitrage volume, fundamental trading too, right? And we can have also, let's say, some kind of passive, stealthy, fundamental trading from trading in the non-arbitrage volume too. I mean, activity that is informed but does not have an instantaneous impact on prices. And we recognize that. What we find is that after the switch to continuous trading, what we classify as arbitrage volume goes up, while what we classify as non-arbitrage volume goes down. So this is suggesting that the overall increase in volume that we had seen before is driven by toxic volume. And insofar as the non-arbitrage volume is driven by this traditional end users of liquidity, suggests that the switch to continuous trading has lowered the gains from trade for these particular traders due to the increase in transaction costs. So as I said, we have assumed that this non-arbitrage volume is mainly due to uninformed trading, right? But there is the possibility that it has informed traders too. So because the volume decreases, if this is driven by informed traders, we should expect price discovery to suffer somehow. So we take this possibility to the data too. And what we do is to replicate a methodological approach used by Weller in a paper published at Review Financial Studies, in which he examines price discovery around earnings announcements. And his suggestion is that if fundamental trading intensifies, we should expect the market to discover the earnings news or more earnings news before the earnings announcements date, right? And we should expect the reaction of the market the date of the announcement to be smaller. And he introduces a metric called the price jump ratio, which is decreasing with the amount of information that is discovered before the announcement. So we use this metric, and we collect earnings announcements dates for all the Taiwanese listed stocks and the Korean listed stocks between January 2018 and November 2020. And we look at whether there are changes in this price jump ratio between the two regimes. And what we find is summarized in that table over there. We find nothing. There is no significant change. There's no significant, apparently there's no significant change in the price discovery in Taiwan, which means that the increase in toxic volume we have seen before should be mainly, or is apparently driven mainly by latency arbitrage, and the decrease in non-arbitrage volume we have seen is likely attributed to these end users of liquidity. We have repeated the analysis with macro news, and we have repeated analysis with merger and acquisition announcements. Results are the same. Finally, we examine our results in the cross-section. So we split the sample into subsamples based on trading volume, and we find that the increase in adverse selection cost, the decrease in realized spreads, and the net increase in transaction cost is more prominent among the higher volume stocks. In fact, for the lower volume stocks, the increase in adverse selection cost is offset by the decrease in realized spreads, and there is no effect on liquidity. We also find that volume increases more in the higher volume stocks, which again corroborates this connection between latency arbitrage and volume in our study. So I think the main message that our study sends is that optimizing the market design is a complicated, intricate balancing act with net effects on liquidity that depend on many, many factors. In the Taiwanese experiment, the transition from frequent batch auctions to continuous trading shows a significant increase in adverse selection costs that is not offset by the improvement in other market-making costs, and as a result, transaction costs increase. Do we expect this to be generalizable to other markets? If other developed markets decide to adopt frequent batch auctions, should we expect to find the same that in Taiwan? We believe that the adverse selection cost effects should persist, and maybe except in the case of ultra frequent batch auction, and by ultra frequent I will mean auctions with a frequency that match the speed advantage of the fastest traders in the market. The market maker should be able to reduce the risk of being picked off, and therefore adverse selection cost should improve, should decrease. Regarding the second output, the decrease in realized spread of the switch to continuous trading, that if we move in the other direction should be an increase, right? With respect to move in the opposite direction. Should we expect this to be generalizable? Our response is that we are far less certain. Why? Because, like I said, this is a composite metric. So it depends on what happens with inventory holding costs. It depends on what happens with order processing costs. It depends on what happens with competition in market making. And so the net effect on liquidity will ultimately depend on what happens with that component, what happens with the realized spread, with the direction and the magnitude of the changes of these other market-making costs that, at least in theory, have been ignored so far in this discussion. So our, let's say, first message for the industry will be to those market operators that are thinking about mandating frequent batch auctions, that they should consider this possibility carefully, and they should adapt the frequency and the characteristics of that regime to the particularities of their trading platforms. And this comes the second message. We find that this increase in transaction costs after the switch to continuous trading is not compensated by improvements in price efficiency, and that these increases, this change to continuous trading in Taiwan comes with an increase in volume, but this volume is toxic, according to our results. And not all the participants in the market get benefited from the switch to continuous trading, because the participation of certain traders, traditional liquidity takers and informed traders, falls. So we think that this result is important because it can explain why the industry can be reluctant to change the status quo. On the one hand, if we move to frequent batch auctions, adverse selection costs we expect will decline, and this could be beneficial for the end users of liquidity. So this could be welfare improving. But on the other hand, if we move to frequent batch auctions, the market will sacrifice an important revenue driver nowadays, which is latency arbitrage volume. So this, what I'm trying to say is that when it comes to optimal market design, the interest of the industry and the social interest may not be aligned. And that's basically all. Thank you.
Thank you very much, Roberto. The discussant is Erik Einert from SSMA.
Thank you very much. Very interesting paper, and very. I think it will be discussed very actively the next couple of years, because I think this will be on top of the agenda when it comes to market structure. Just a little background. I joined the industry back in '89. At the time, I joined the option exchange. At that time, the trading was done on whiteboards via phone. So I've kind of seen all the development through all the different steps of electronification and development of algos and high-frequency traders and all that. And also I've seen, why are we here today? The fragmentation. I mean, before MiFID I, we had a monopoly exchange, and we wanted to attack the execution fees. What did we get? We got MiFID I, which meant that we got competition of new exchanges, new MTFs, and we got a race to the bottom when it came to tick size. Then eventually we got MiFID II, and we got a tick size regime, but too narrow in my mind. But we have touched upon that earlier. And also we got a further fragmentation with all the SIs. So the question is, I mean, how can we cope with this fragmentation? So that's a kind of the baseline. I mean, you can execute equities, I think, in 600 trading venues in Europe or something like that. So. And now the regulator wants to make Europe competitive and also tackling this fragmentation. But before I go into your findings in your paper, I would actually like to connect to where Björn started this morning, the flash crash that we had on Monday here in Stockholm, where a large bank put in too large erroneous basket order, which had the effect that our market fell by in a couple of minutes by 7%. So I mean, it's not in your paper, but do you think an event like that, where you have kind of a slow fat finger event that affects the whole market and ripple through all these different high frequency traders and affect different instruments, knockouts and what have you, do you think that event would have been different if we would have a frequent back auction system, or as we now have, we are having a continuous trading model?
Well, first thing I want to say is that Eric was so gentle and kind to throw me that question yesterday during dinner. So I had time to think a little bit about this one. So the first answer that came to my mind was my own experience. I did a research on circuit breaker mechanisms in Spain back in the days. And in Spain, when the prices of a stock reach a certain price limit, they switch to call auctions, and they last 5 minutes. And one of the things that we found in that study was that volatility remained unusually high 30 minutes after the continuous session was resumed. So my first thought was, okay, so if 5 minutes is not enough to cool off the market and to the market participants to reach a consensus price, and I don't think that the Spanish researchers should be particularly dumb, then why 100 milliseconds auctions should stop flash crash from happening, right? Then I recall another paper, theoretical paper by Madaman from 1992, who already said call auctions are better for aggregating information, and call auctions can help to are better to stabilize in markets. So you have opposite arguments here. So I decided to go to Google Scholar. So I looked for papers, and I found a couple of papers. All of them are experimental markets, simulations, and so they're not based on real data. And they try to see if different possible regulatory actions could help to stop flash crashes. And they basically the two studies find that frequent batch auctions could be a better solution. None of the solutions will prevent the flash crash from happening, but they conclude that frequent call auctions could help to mitigate the effects and to facilitate the recovery. And they consider very standard way of implementing the auctions. I mean, just like that. I mean, auctions. We accumulate orders. We arrive to an allocation price, and we move on to the next auction. So I thought, okay, so maybe a way to help to improve that design could be within of these frequent auctions, we could include a circuit breaker, so that if the allocation price during one of these frequent auctions were to exceed a given threshold with respect to the allocation price of the previous frequent batch auction, we do not allow an allocation to happen. So it's like imposing a halt, but it's a dynamic halt, because at some point, this variation in prices will fall within the limits, and then the continuous session the session will continue in a normal manner. So the idea is to give time for the market to rethink about the true value of the assets, to think about these kind of events have fundamental reasons behind, and we adapt the duration of the halt to the needs of the market.
Interesting. So maybe.
Thank you for throwing the question.
It's a difficult one, of course, to answer. But yeah, I mean, if I understand you correctly, you could see maybe slowing it and probably make it a quick recovery. But we would have seen a big fall if I conclude. Yeah. Going back to your paper, you kind of discuss. You could say 3 different types of market participants: the latency arbitrageur, the market maker, and the non-informed investor, so to say. And you see that the toxic information and it's in the advantages of the latency arbitrageur on the cost of market makers. But what about the non-informed client? I mean, the exchange is for price discovery and also making markets liquid, making non-informed clients meet as efficiently as possible. Could you elaborate? Could you see how big the effect was on the non-informed client when it comes to execution quality? Were they also at a disadvantage to the same extent as the market maker?
Yeah, in one of the, you let me go back to the presentation for a second. Controlado? Okay, thank you. Yeah, here when we split the volume into arbitrage and non-arbitrage, we expect that this non-arbitrage will capture most of this uninformed trading activity you were mentioning. So according to the test, what this suggests is that continuous trading, because of the increase in transaction costs, is not beneficial for these traditional uninformed traders. And in that sense, going into frequent batch auctions should perhaps generate the opposite effect, right? So be welfare improving for them. Yeah.
Yeah, because that is my second topic is because I think that is what it will be all about, optimizing the different market models going forward. And since you also state that, I mean, if you have more volume in latency arbitrage, and you kind of implicitly say that exchanges want the continuous model to get higher fees on transaction costs because of that volume. We come from, I think the situation was something that I was reminded by Søren here, that we have not discussed really, is the market data costs and the costs for indices. So the exchanges are actually on the side now increasing the revenues on other in revenue streams, market data and providing indices. And at some point, connected with, especially see very low liquidity and depth, especially during middays in trading sessions. Do you think that the is the optimal way a continuous way, a frequent batch way, or like we are experimenting today with continuous, and you can start manually a frequent batch auctions to find liquidity? So I mean, could you elaborate a little bit about that different ways of trading?
Optimal in what sense?
From the exchange. I mean, my view, I have a quite strong view. I say that we will not have continuous trading in 3 years or 5 years because of the fragmentation and that they are trying to find liquidity elsewhere. So the only way for exchanges to keep the volumes will probably be to adopt some sort of auction model. So.
Yeah. So the results of this study suggest that if they move to frequent batch auctions, volume will fall because the latency arbitrage volume will disappear. But it could be, there could be, and that's also shown by the paper, an increase in the traditional volume by uninformed traders. The results do not suggest that there's going to be an offsetting effect. So whether this could be compensated by markets by profits from other sources like the data sets, I'm not sure, but my guess is that the amount of the revenues coming from the data, the selling the data, should be increasing with the volume traded, right? Because it would depend on the amount of the data sold. So if volume falls, the profits from selling the data should also be negatively affected. So no offsetting effect in that way. So, so as I have said, what we see is a conflict of interest here.
Yeah, it is, and I usually try to argue from the end client view that they want as much liquidity. I mean, so I think at some point that will be the deciding factor how we organize trading going forward. But one last question, just to summarize. I mean, we have touched upon tick sizes all day, and both Chris and I have strong views that they are too small. Do you think? Do you think that has an effect on your results, that we have in my mind, very small tick sizes, which kind of creates thin order books, which makes the toxic information more damaging because there is not enough volume to cope with that information hitting the market?
It doesn't have an effect on the study per se because it's not the case in Taiwan, right? But it may have an effect on the generalizability of some of the results. Again, I don't think it's going to affect the adverse selection cost effect. We think that this is quite, the result is robust in no matter how we look at it. And it's supported by theory, but it may have an effect on other components of these components of realized spreads that the theory has ignored so far. Yeah, definitely.
Okay, thank you very much.
Thank you, both of you. Are there any questions from the floor now?
It's a great paper, obviously, as someone that's done one on latency arbitrage as well. The question I have, and it speaks to the generalizability of the event. Does Taiwan have a rich competing exchange, which perhaps didn't switch or was continuous throughout the whole?
No, it's a centralized market. And that's cool for us because we want to isolate the effect of the switch, right? If we are in a fragmented environment, then there could be confounding effects, not only for the pandemic in our case, but also for possible migration of traders from one platform to another, and it will be more complicated to measure. Also, the bodies theory does not consider fragmentation. It's a single trading platform moving from continuous to.
Yeah, indeed, and that's why it's a common criticism of his model is that there's a coordination problem in implementing this, where one exchange does it and then this.
Exactly. The question is, all the markets move to frequent batch auctions. If that happens, our results will be more generalizable. If only one trading platform moves, I mean, it's highly likely that adverse selection cost in that platform will decrease. But what is going to happen for the overall market is we cannot anticipate it.
One way to look at it would be, for example, in our paper, when we see the US market open at 2:30 London time, we see a massive jump in volume and also speed races or latency arbitrage. you could do a similar thing with perhaps some stocks that have very high correlation, you know, with other exchanges in Asia that perhaps, you know, would involve more speed races than others, potentially.
We can look into that. Yeah, thank you.
I'd like to add on to Peter's first question here. I see the point that Taiwan is a nice laboratory to test the theory, but in a fragmented market, I think a very important part of running call auctions is that that's an opportunity for the exchange to essentially monopolize the market. At the time of the opening and closing calls, they have the monopoly. So that could make it very attractive for them to adopt frequent batch auctions if it had that effect on fragmentation, wouldn't it?
You mean all the trading platforms at the same time?
So if we take the context here that if Nasdaq would follow Eric's prediction and adopt batch auctions instead of continuous trading, it could potentially reduce fragmentation a lot, is my thinking. And then they wouldn't be concerned about losing the latency arbitrage volume because they earn a lot of volume from the competition.
Obviously it could happen. I mean, we cannot predict that on the basis of our study, obviously. So it's all speculative, but it's obviously possible situation or a scenario, yes.
So I would come after your neck, as you predicted. No, not really, but I have two questions. Maybe I'll reduce it to one. You said that there is a negative effect on real volume, you would say? That is
real volume?
That is non-arb volume? I mean, it's compensated with a higher arbitrage volume, as you see. So where does it go if it's not a fragmented market? Is it off exchange?
The overall volume increases. So what we find is that the increase in toxic volume explains the increase. That's our prediction, and we have a negative effect on the non-arbitraged volume. So that one is increasing. So in net terms, total volume increases, toxic volume increases, and non-arbitraged volume increases. It doesn't have to go anywhere. I mean,
I get it. Now the model, the British Crampton and Shim, the effect of arbitrage opportunity arises because it's a stale quote relative to another quote, right? That's sort of the idea in their paper. They look at relative pricing. So what is the relative in your sense in Taiwan? Do you look at futures and then as a follow-up, what happened with the futures market? Because that's relatively big, right? And what kind of trading mechanism do they have?
They have futures markets in single stocks, I think. These are the most active they have. We haven't looked at them. But again, the question will be if we can test if this increase in volume is connected with signaling events happening in the futures market. That could be a possible test that we can run,
You don't know what kind of, do they have batch auctions too, or did they go through a similar change?
No, it's continuous.
So that was continuous from the start?
I think so, yeah.
This gives you kind of a benchmark, right?
Yeah. Do you mean it could be, to control,
I mean, if that continues before, then it would be, information would show up in the futures before the batch auction, right? And then it would be level playing field afterwards.
I think we tried to get some data from futures markets, and there was nothing very exciting in it. But I don't, since this has been running for 3 years already, I don't remember exactly why we declined that possibility. But I will bring back idea to the co-authors and see if they remember better than me. Thanks.
It could be as an old index market maker, of course, if you have a, it's easier to re-hedge a basket if it's continuous trading. So it's, I mean, not knowing, I would guess that large futures order could have an impact, more impact the equity side in a continuous trading model.
So thanks, Roberto. This is a very interesting paper. I was just wondering, just in terms of your toolkit, right? So you have a bunch of metrics that sort of historically have been generated in a limit order book setting or maybe a dealer market setting. How do these metrics translate to a single price call auction, right? So for example, how should I interpret a quoted spread in an auction? Because if there is a volume, then the spread is negative, right? I mean, if you sort of measure it the way we do it in a continuous market.
Yeah. We have been, this was a tough part of the analysis, right? How to somehow adapt to the metrics we are all familiar with in the continuous benchmark to the call auction scenario. For the data we have for the frequent auction phase, is every time there is a successful auction, and by successful I mean that there is allocation, we have the allocation price, the allocated volume, and we see the book immediately after allocation. And if the auction is not successful, then we see the book as it is at the end of the auction. When we measure quoted spreads, we do it in the traditional way, based on the book information we have. When we compute effective spreads, then the tricky part comes in, what do I take as a quote midpoint, right? And when we compute price impacts, we have the same issue. So we used to have a discussion about this in the appendix, an appendix to the paper, but we tried different options. So should we take the quad midpoint after allocation as a proxy for the market consensus value? Should we just take as like a quad midpoint at the end of the previous auction? Should we look for something like some rule that is a variation of the quad midpoint with respect to the quad midpoint after the allocation, depending on whether the volume is in the buying net volume, or the allocated volume is more buying oriented or selling oriented. So we try many different possibilities, and the results were always the same. I mean, we were always finding this increase in advanced selection cost, no matter the reference we take as a consensus value. Okay, and what else? Quoted depth, we use the information in the book. It's all we have.
Okay, but then that's not, I mean, in a continuous market, when we see that there are say 20,000 euros depth, that's sort of, for somebody who wants to trade, I can potentially trade 20,000 euros. That's kind of, I mean, depending on how the transparency works in the auction, it's not necessarily how one would interpret depth, right? In a single price call option. That's almost like depth that didn't execute, right?
It's an executed depth. That's right.
Maybe one follow-up. Are you able to look at like institutional transaction costs? Because I mean, one of the sort of advantages of having a continuous limit order book is that there is a high level of immediacy there, right? So if you want to really trade very quickly, you can do that, and that potentially with 5-second auctions suffer. So if, for example, you can capture things like, in the implementation shortfall, the level of opportunity cost that exists, and whether that changes, I think that would be very interesting.
We don't have order by order data, so that's not an option for us. It's a good idea, but we cannot do it.
Okay, thank you. Let's give a hand to all the presenters and discussants for this session. And it's time to wrap up this event. I would like to start to thank all the presenters and the discussants for taking the time to come here, and also to the attendees. Great to have you all here. I think we have learned a lot, at least I have. And one takeaway really is that market fragmentation is a complex topic. There are a lot of details to understand to see how we should change policies going forward. And I think that complexity really merits more interaction between academia and regulators and the industry. So I'm very happy with this collaboration between the university and the trade association, and I look forward to continue that. We have a very active group at Stockholm Business School in market structure research, and also in other universities in Stockholm and in Europe and Australia, as you have seen here today. And we are always happy to interact with the industry and regulators to think about the future policy. Now, this marks the end of the discussion today, but if you want more, there is more, because we have a conference at Stockholm Business School in a couple of weeks, the Future of Financial Information conference that we have every year, and we're happy to have it back as a physical conference again. So if you're interested in hearing more about the market structure discussion in academia, you're more than welcome to join then as well. It's on May 18th to 20th.